Turn on the news. It doesn't matter if it's morning or night, weekday or weekend. The story is always there, lurking in the background. The world's financial health, or rather its sickness, is broadcast into our living rooms every single day. Headlines scream about the national debt, surpassing $40 trillion, record debt to GDP ratios, and looming government shutdowns. It's a terrifying drumbeat, echoing through every news cycle. The numbers are so staggering, so abstract, that they almost don't feel real. But they are, and they're growing. The financial monster grows larger with every political decision to spend. Each new bill, each emergency relief package, each tax cut or spending increase adds another layer to the mountain of debt. Politicians argue, debate, and compromise, but the end result is almost always the same. More borrowing, more promises, more red ink. Whether it's rebuilding crumbling roads and bridges, expanding military budgets, or funding questionable programs that never seem to deliver, the bill always comes due, and when it does, it's the taxpayers, ordinary people, who are left to foot it. The numbers are so large, they've lost meaning. We hear about billions and trillions as if they're pocket change, but most of us can't even imagine what $1 billion looks like, let alone $1 trillion. $1 trillion is a million millions. If you stacked $1 trillion $1 bills, the pile would reach nearly a quarter of the way to the moon. It's a sum so vast, it's almost incomprehensible. The US, the world's largest economy, is also its largest debtor. But it's not alone in this predicament. The debt crisis is a global phenomenon, touching every continent and every major economy. Japan's debt is more than double its economy. For every dollar the country produces, it owes more than two. Decades of economic stagnation and stimulus spending have left Japan in a financial straitjacket. European nations teeter on financial collapse, propped up by loans that only add more debt. Protests erupt in the streets, businesses shutter, and governments scramble to keep the lights on. Emerging economies are shackled by decades-old loans, crippling their ability to build hospitals, schools, or even basic infrastructure. The weight of past borrowing stifles their future, trapping millions in cycles of poverty. It's a global pandemic of red ink. No country is immune. From the richest nations to the poorest, debt spreads like a virus, infecting every level of society and government. This debt isn't just numbers on a spreadsheet. It dictates policy, influences elections, and limits funds for healthcare, education, and infrastructure. Every dollar spent on interest is a dollar not spent on the people. Governments must make impossible choices, cut spending, raise taxes, or borrow even more just to pay the interest on existing debt. It's a vicious cycle with no easy way out. It's like taking a new payday loan to pay off the old one. The debt never really goes away. It just gets rolled over, growing larger and more dangerous with each passing year. The constant crisis keeps the public in a state of low-level panic. We're told to tighten our belts, make sacrifices, and accept that there's simply not enough to go around. Families worry about their futures, businesses cut back, and hope feels in short supply. But is this system of financial submersion an accident, or was it designed to trap us with no escape? As the world drowns in red ink, we have to ask, who benefits from this endless cycle of debt, and is there any way out? If every country is in debt, who holds the money? It's a question that puzzles many. We often hear about national debts reaching astronomical figures, but rarely do we stop to think about who exactly is on the other side of this financial equation. Are we in debt to Mars? Of course not. It's a humorous thought, but it highlights the mystery surrounding global debt. The truth is far more terrestrial. The answer is, the world owes the money to itself. It's a complex web of financial obligations that ties nations together in a global economic dance. It's a financial Ouroboros, a closed loop where money circulates endlessly. This cycle is both fascinating and perplexing, as it sustains economies while also creating dependencies. A country's national debt is mostly government bonds, fancy IOUs sold to raise money. These bonds are promises to pay back with interest, a tool for governments to fund projects and services. Who buys them? Entities within the country. Pension funds, insurance companies, investment banks, and central banks. These institutions see bonds as safe investments, a way to grow their capital while supporting national economies. The government owes money to its own citizens and institutions, like borrowing from your savings account. It's a cycle of trust and reliance where citizens indirectly fund their own government's operations. Other major buyers are other countries. China holds over $1 trillion of US debt. This international lending creates a network of financial interdependence where countries rely on each other for economic stability. This web of mutual obligation is seen as stability, but it links every nation's economic health. When one nation falters, the ripple effects can be felt worldwide, underscoring the interconnectedness of our global economy. A crisis in one corner can trigger a domino effect globally. Financial markets are sensitive, and a single event can lead to widespread economic turmoil, affecting millions. Global debt is interlocking claims between governments, central banks, financial corporations, and a wealthy sliver of the population. This concentration of wealth and power shapes the financial landscape, influencing policies and economies. It's not external debt to aliens. It's an internal wealth transfer. The money circulates within our planet, shifting from one entity to another, creating a complex tapestry of financial relationships. The money is owed by taxpayers to private entities with capital to buy government IOUs. This relationship underscores the role of citizens in sustaining national economies, as their taxes fund government operations and debt repayments. This isn't a bug, it's the system designed this way. The financial architecture is intentional, crafted to maintain economic flow and stability, though not without its flaws and challenges. To understand how, meet the architects. These are the minds behind the system, the economists and financial experts who shape the policies and structures that govern our global economy. Their decisions impact us all, weaving the intricate web of debt and finance that defines our world. This system was engineered, not accidental. 4 key figures built its core principles, each adding a crucial pillar. William Paterson, a Scottish merchant, revolutionized government debt in the late 17th century. Nathan Rothschild, a banking patriarch, turned government debt into a global commodity in the early 19th century. J.P. Morgan, a power broker, helped create the Federal Reserve, giving the government limitless borrowing ability. Paul Volcker, as Fed chairman, used bailout loans to impose economic policies on struggling nations. Paterson, Rothschild, Morgan, and Volcker. 4 men, 4 innovations, 1 inescapable system. In 1694, England was broke after expensive wars. The country's treasury was empty, drained by years of conflict and the enormous costs of maintaining armies and fleets. The streets of London echoed with uncertainty, and the government was desperate for a solution to its financial crisis. King William III needed money fast. The survival of his reign, and perhaps the nation itself, depended on finding funds to pay soldiers, rebuild the economy, and defend against future threats. Traditional methods of raising funds, like increasing taxes or borrowing from wealthy merchants, were deeply unpopular and unsustainable. The public resented higher taxes, and lenders demanded high interest for risky, short-term loans. The government's options were running out. Enter William Paterson, a Scottish financier with a bold new idea. He proposed forming the Bank of England, a private institution that would lend the government £1.2 million, a staggering sum at the time, in exchange for special privileges and influence. The deal was simple, but revolutionary. The government would pay 8% interest every year, but it would never have to repay the original loan, the principal. This meant the debt would last forever, with interest payments continuing indefinitely. This was the birth of perpetual government debt, a radical departure from the old system, where loans were expected to be paid back in full after a set period. Before Paterson's plan, government borrowing was always temporary. Loans were taken out in emergencies and repaid as soon as possible to avoid the burden of ongoing interest. Paterson's model changed everything. Now the government could borrow endlessly, rolling over old debts and taking on new ones, with no fixed end date in sight. The government gained a steady, reliable source of funding, while investors, many of them wealthy merchants and aristocrats, enjoyed a guaranteed income stream backed by the power to collect taxes. The creation of the Bank of England blurred the line between public finance and private profit, intertwining the interests of the state with those of powerful financiers. A small group of investors now held a permanent claim on the nation's future tax revenues, shaping the course of British finance and politics for generations. Paterson's invention didn't just transform England, it created a model for central banking and perpetual debt that would be copied by governments around the world for the next 300 years, shaping the global financial system we know today. Nathan Rothschild turned government bonds into a global, high-stakes industry. He made bonds as easy to trade as commodities, creating a network across Europe. Rothschild's method: information is money, and speed is everything. By creating a liquid international market for bonds, he changed government debt's nature. Governments could sell debt globally, expanding credit but subjecting them to international investors' whims. National sovereignty became hostage to the global bond market. Rothschild wove a web of financial obligation with his family at the center. He turned IOUs into complex financial instruments, making governments dependent on bankers. In the early 20th century, America needed a central bank to stabilize its chaotic financial system. J.P. Morgan, a powerful banker, organized a bailout during the Panic of 1907. A secret meeting on Jekyll Island in 1910 led to the Federal Reserve Act of 1913. The Fed was a decentralized network of regional banks, designed to look public, but owned by private banks. It gave the U.S. government a lender of last resort with the ability to create money. The Fed could buy government bonds with money created from nothing, monetizing the debt. This removed any physical limit on government borrowing. The government could borrow and spend on an unimaginable scale. By the 1970s and 80s, developing nations faced massive loan defaults. Paul Volcker's policies as Fed chairman led to skyrocketing interest rates. The IMF and World Bank orchestrated bailouts, transferring debt from private banks to public institutions. The IMF loan came with structural adjustment programs, forcing debtor nations to restructure economies. These policies ensured countries could generate foreign currency to make debt payments. Volcker turned debt into a tool of control, allowing unelected bureaucrats to dictate economic policies. The debt trap was complete, a system of governance where countries owed obedience. How does this system work today? It starts with you, the taxpayer. Your taxes fund government spending, including interest on the national debt. A significant portion of tax dollars goes to bondholders' pension funds, foreign governments, banks, and the wealthy. When tax revenue isn't enough, the government borrows more, issuing new bonds. The same financial institutions receiving interest payments buy new debt, lending the government its own money back at interest. It's a perpetual motion machine of profit, powered by your taxes. The system privatizes gains and socializes losses, funneling wealth upward. This isn't a story of good versus evil, it's a story of design. Each architect solved a problem, forging a chain binding the world. Patterson created perpetual debt, Rothschild made it a global commodity, Morgan's Federal Reserve removed borrowing limits, and Volcker weaponized debt. The perfect trap. Debt never paid off, traded globally, financed by infinite money, enforced by international institutions. Escaping this system is impossible. It's designed to transfer wealth from many to few. It's not broken, it's working as intended. We, the taxpayers, are the fuel keeping the machine running forever.